Good morning and welcome. For those of you who don't know me, my name is James McFall and I'm the Managing Director of Yield Financial Planning. I also chair our investment committee, which includes our partner stockbroker and head of our research at our licensee. These are certainly highly unusual times. I'm currently presenting to you from my lounge room as my wife and kids work in other parts of the house, and no doubt a number of you will be in a similar situation right now. It's clear that the economy is being impacted by this pandemic. In fact, we're currently in what will be recognised as a recession right now, which is Australia's first for more than 28 years. And with that backdrop, it's time to reflect how share markets have been performing and how they are likely to perform moving forward. With that in mind, we've invited Benjamin Moore, Australian Managing Director at Global Fund Manager Alliance Bernstein. Ben brings more than 20 years of investment experience, and Alliance Bernstein run a very interesting fund that is designed to manage volatility, making them a perfect manager to ask to speak to today. The Managed Volatility Fund has been a top performer of over 1, 3 and 5 years when measured against its peers, and it is unique as it aims to take only half of a market downturn when markets are negative while still capturing at least 80% of market upside when things are more positive. Ben will provide some insights into how they have been managing their share portfolio in this pandemic to this point, and also some insight to Alliance Bernstein's outlook moving forward. Also with us today is Yorkie Orr, who is a Senior Financial Planner with Yield. Yorkie and I will be asking Ben a series of 7 questions. And also as part of this, you'll be able to ask questions. You'll see on your screen the option to write your questions, which can be anonymous if you like. Our intention will be to interject and ask Ben these where relevant and time permitting. However, if there are questions that we don't get to answer live, we'll respond to you after the presentation. Before we get going, it's important to state that this presentation is general in nature and is not personal advice. But if you would like to speak about any aspect of what we cover here today, or have a review of your financial plan, we'd welcome the opportunity to talk to you later at a later point. Ben will have a more robust disclaimer to share with you, I'm sure. So with that introduction, I'd like to welcome you, Ben, and so welcome you here today.
Thank you. Pleasure to be talking to you.
Thank you. Well, as a first question, can you just tell us a little bit about what you're seeing in the world economy at the moment?
Certainly. And before I do that, James, I will use my robust disclaimer in that I'm going to talk about Alliance Bernstein's views of the economies around the world, which include stock markets and bond markets, and we'll even get into some stocks. So just confirming it's information that we work as a firm. We've got the likes of you, James, to provide advice to clients. We don't know your clients, so it is very much general in nature, the stocks that I talk about today. But very happy to take questions on stocks and markets as they go through. So great question to start about how do we see the world economy, and it's tough. I would say challenging in a word is the way to look at it. And unlike the GFC or past crises we've seen, this is everywhere. There are some countries that have done better, and when we look at lives lost, Australia has actually done considerably better than more developed countries around the world. Nearly 330,000 people have died since the outbreak of COVID-19, and that is just a tragedy. To see that impact on lives is huge, and that has an amazing impact on how people feel and think. You can imagine in those countries where they've been hurt the most, so think Italy, Spain, France, the US, in parts of the US, you're definitely seeing it different in New York to other states. It's had a dramatic impact on those economies. 38 million Americans are unemployed, 6 million Australians are unemployed. That hurts. James, you're doing this from your lounge room. I'm in my wonderful office here in Randwick in Sydney. This is week 10 for us that we've been working from home. So we haven't been going to cafes, we haven't been going to restaurants. So the money that greases the wheels of economies is just not happening. So I'd also add our concerns are with the developing nations as well, because we've seen in countries like Italy and Spain who have had outbreaks but haven't had the healthcare system to look after them. They just weren't ready for them. And if you look at their debt position, technically Italy was already in a bad position anyway and broke. It doesn't have the money to pay back the debt that's already borrowed and hasn't invested in its healthcare system over the decades. And the same for Spain. So they weren't able to respond with the isolation and the ventilators and the healthcare required that we've seen here in Australia. I want to add to that I just tip my hat off to the healthcare workers. And if you know them, they've been amazing. The shifts that they've been having to work on and off, particularly in Melbourne and Sydney, have just been phenomenal. Times that by 10 if you know anyone who's working in New York and London. The effort that they put in has just been amazing. So when we look at the impetus that goes into economies, which by and large is people spending, travelling, there's no world travel. How often have you looked up into the skies at home and just not seen any planes? I live not far from Sydney Airport and get to go down to the park a lot because we too have a dog. And there are no planes travelling. So there's no travel. Entertainment's different. We're not eating out. So the way we look at economies right now is if they're slow, everyone's in a recession, and it's going to take some time to grind out of this.
Ben, with the above in mind, what does Alliance Bernstein think about how share markets have responded, and what insight can you give us about where we're headed from here?
It's a great question, Ilgi, because it depends on the month. And I say that because we saw a sharp sell-off in equity markets around the world, as particularly in February. Now, we started to get an understanding of what was wrong sort of from that first week in January as the cases out of Wuhan started to grow quickly, and that multiplied over time. It didn't really come as news to markets around the world until mid-February and into March. And I remember speaking to my colleagues in the US at the time, and America didn't really pick up on this until March. They didn't really think this was an American issue at that point in time. And then we saw sell-offs around the world, including our market. So we think there is so much irrationality in markets. We see people selling stocks for the right but wrong reasons, and we see people buying stocks for the wrong reasons as well. And April was a great example of that. We just saw a bounce in markets in April. And the main reason we think about that, and I'll put it into two camps, there's a bull case for equity markets. And that bull case, or the reason I think equities are the way to go in general, so markets in general, the amount of money being printed around the world to keep cash rates and bond rates low is phenomenal. Since January, America alone has printed $7 trillion worth of money to keep their rates low. That's to grease the wheels, to keep borrowing happening. If people need to buy property or invest using borrowed money, rates are going to be low for some time. Japan has bought all of its own debt. And we're now seeing Europe's done it for some time, and we're seeing smaller nations do this as well. So given cash rates are low and bond rates are low, the bull case is, well, surely equity markets would go up because they've sold off so much. And so that is what we saw in April. We saw exuberance come back to the markets, and people think, I'm going to buy stocks again. However, what we saw happen in that month is we just saw companies, a great example is Media, a really good advertising agency that specialises in outdoor advertising. Now, if you think about any company right now, I don't think outdoor advertising is on the top of their list in terms of the spend they're going to do. Because if you think about where they need to spend their money, it's on their staff and on protecting their cash flow. Yet we saw this company go to the market to raise more capital in April, and the stock price was bid up almost 20%. To us, that's irrational behaviour. We don't own any media right now. We think it's an area we want to stay away from. So we think we're going to continue to see bouts of irrationality. And the last thing I'll talk about in markets is the US is in the middle of its reporting season right now. So that's where companies come to the market to say, how are we and how are we looking in terms of our cash flow? To date, 160 US companies have deferred any guidance. That's 40% more than what happened in the GFC. So that's companies saying to their shareholders, we simply don't know what our cash flow is going to look like. We don't think that has sunk in yet. We think as investors start to realise that, hey, I own a company here that's not going to produce any cash for some time. Why am I owning it? And they may look to panic sell. And we think it's going to be the same here in Australia. We think as our reporting season starts in July, goes through to August, there are many companies on our exchange that are just not going to be able to produce any cash. So think Qantas, think Sydney Airport, companies like Cochlear. Cochlear is an amazing company. They do great things, but there's no elective surgery happening anywhere. Queensland's just about to start up again, but until elective surgery is allowed, and where that sits in terms of ear implants, they're probably not going to produce any cash flow until next year. So We think the outlook is for markets is grim. There's opportunities, and I know we're going to get to that later, but we think there's irrational behaviour both on the buying and the selling side, which has presented good opportunities for us.
Yeah, that's fascinating, and I think that you've just highlighted really well what the some of the the peculiarities and the uncertainty that we're facing. Ben, on that note, given your fund is a managed volatility fund, true to label, you did really well in the March fall. You beat the market by 9% in that period. Can you share with us some of the ways that you manage volatility?
Most definitely, and James, it's worth noting we are a defensive bearish manager. We've got a role in a portfolio, and that's exactly what we're designed to do. So we're always looking for what can go wrong. So the premise of the way we manage money, and we want to make you money. We've invested in equity, so there's risk with that. We want to give you a better return over time. Is our premise is we think about three things first. We want companies that have just got that are different from the benchmark and what we call that have stable share prices. So they're companies where they're not as impacted in terms of general market conditions. So we think about things like Transurban, ResMed as examples there. And by different to the benchmark or our market, 67% of the ASX is made up of banks, which we only own 2 and at very small weights, who have had a terrible run and will continue to for some time. Energy, so we don't own any oil companies. And then lastly, miners. We do own some, and I'll talk to that a little bit later, but we're very much underweight those sectors. If I go back to thinking about how did we get to March and how did we perform well, is in January, Roy Maslin, who runs the portfolio, and myself and the team, we sat down and went, what do we think will happen and where are our risks? And straight away, we looked at Qantas and Sydney Airport that we had in the portfolio, and we sold them. It took us 2 days. We owned tens of millions of dollars in both those companies because we could see this. Our view was there was a risk to the downside, so let's get out of that. And making that decision then, we got out and took profits in both those companies at that point in time, and they've gone on to fall well over 15% from that time. So that were the first decisions we made. We then looked at, okay, what's next? And this is as we got through to February, which was who's not going to generate cash flow as lockdown started to happen. And then we looked at all the sort of more consumer discretionary, so shopping, eating, that sort of thing. And we'd already been very much underweight retail malls. So I think Camberwell is arguably the biggest mall. We've got Bondi Junction here in Sydney. We just knew the shopping patterns of people were going to change. So we'd already sold out of our positions in retail malls about 18 months ago. And that was really to do with the impact of Amazon, people buying more online. And that's proved to be, has helped us. But then we looked through our portfolio. We had JB Hi-Fi in there as well. So we sold JB Hi-Fi, which was good. We then looked at REA Group and then just went, you know what, people aren't going to buy and sell properties as much. And as you've seen in Melbourne and Sydney, auctions have been banned. And if you think about the biggest turnover for REA Group was 1, advertising the property, and 2, advertising the auction. They're slowly starting to come back. So it was quite obvious we wanted to be out of that as well. And then Wesfarmers, we had a big position in Wesfarmers. And whilst we love Bunnings, we think Bunnings, we all love Bunnings, right? I like going to Bunnings. I live near to Bunnings. It's one of my most favourite places to go. We own the Bunnings Property Trust, but we didn't want to take the risk on Kmart and Target because we just saw a real issue there. So we sold out of those. And what we did is we'll go through later as some of the things we've been buying. But as a result of not owning those things, we did buy some other stocks, and I'll talk through those. We increased our cash position to 14% at that point as well. And that certainly was that was a big part of not taking as much of the hit. Meant we saved almost 50% of what the market went down is what we went down, and we've since rebounded strongly since.
Yeah, I think that the fact that you've got that ability to own some cash, and the also having some flexibility to own some international shares, but being investment agnostic, it's certainly not a time for index managers, is it? It's active management where you can completely steer away from certain sectors that are underperforming is going to greatly improve your potential outperformance.
Most definitely. The thought of owning everything in an index right now just has no appeal to us at all, because there are so many companies that are impacted by no cash flow, people that just won't spend. There are other companies that will continue to generate cash flow that we're happy to own. You mentioned the international component, so 20% of our business is, or the portfolio is invested in global stocks, but we also made some changes there. We own things like McDonald's, as an example. And so whilst McDonald's is still open here in Australia and we can go there, it's not in New York and it's not in the UK and a lot of parts of Europe. So that's a global franchise. We wanted to be out of that. Adidas was another stock that we own. We just didn't see people running out to buy trainers, although when I look at my own wife's online shopping patterns, they certainly haven't changed. They've actually gone up in isolation. We're doing a bit for our economy here in Ramsden, that's for sure. But we moved those names into global healthcare names, things like Roche and any of the laboratories. We were keen to invest in those. And we also bought a company called Citrix, which is basically the remote office working system that we're all using today. They're part of the componentry that's in that. So that certainly helped as well.
Thanks, Ben. Just before we ask the question, if you need any of your slides, just let me know and I'll have to bring them up.
Cool. No, we're good.
Ben, would you be able to tell us how you were able to pick the March fall when it happened so quickly?
Yeah, a lot of work. It's a really good question, and it definitely wasn't a hey, let's go to 14% cash, which I mentioned before. We spent hours on all of the stocks we owned, all the stocks we could own. What's the thesis for owning these stocks? And I think now more than ever, good old-fashioned work is how you win. You've got to go and do the work on the company. You've got to know the CEO, you've got to know the CFO, you've got to know their senior management, you've got to know why are they invested in the future cash flow generation of that company, which is where we spend an inordinate amount of our time. So we then spent, which each of us have names in the portfolio that we think will do well. So all the analysts in Roy's team would sit down and say, hey, look, I think Qantas could get through this. And what Roy would do with our economists is give us reasons why it wouldn't. And clearly that was a good call. So as a team, you've got to have, you certainly can't have an ego in these meetings, because if you've got an idea that you think will work, you're going to those meetings to have your peers give you reasons why not. And I think that's a great, robust discussion to be having at this point in time. So we're able to do that with our entire portfolio. We had to do a lot of work with the debt market. So who is willing to continue to borrow, lend to companies, even though they're not going to produce any cash? So knowing that was important. What was the debt of all the companies that we owned? And Transurban's a good example there. People were worried about traffic. Now, they're a toll road operator, and there's no doubt that traffic has gone down. But we're happy to continue to own this company, and the reason being is their balance sheet is amazing. Their debt is at a fixed rate of around 4% over 9 years, and a lot of cash at bank, and their cash flow has been hurt, but it's not been hurt as much as others. So when we've seen that sold off, we bought that. So I would say the reason we got March right goes back to what our process is. Strong companies with great cash flow and future cash flow. We want them to have stable share prices. We don't want to pay too much for them. So as they get expensive, we want to be out of those names. But then we do things like, where is each company in its cycle? Most companies have a cycle. And where companies typically hurt us the most is when they get to the end of that cycle and sell off. Think about if we were 12 months ago talking about Qantas was roaring. This was a stock, if you go back 5 years ago, got to 30 cents. It was going to the government saying, hey, I need a loan. It got to $6.90, nearly $7. It was a wonderful airline, and still is a wonderful airline. It's really well run. But clearly it's got some issues right now. So cyclicality is something that we think about. Think about when Aldi came to our market and what that did to Woolworths. We need to be aware of that when that happens. Balance sheet, we spent a lot of time poring over balance sheets, and we just didn't want to be in companies who had too much debt without the cash flow to meet those debt requirements. So, and anyone that was thinking about mergers and acquisitions, we wanted to be away from that. And then event risk is the last thing we typically look for as well, which is what could happen over the next month or quarter that could have an impact. And that was where we came to that decision on REA. We just looked at how many how much money they made in advertising around auctions alone. And given that Sydney and Melbourne is where they get the bulk of their advertising, given our high rate of our property markets, you turn that tap off, that's a huge hit to their cash flow around for their earnings. So we just knew that that was an event that we couldn't continue to own that stock, took our profit and got out of it. When we did that, as I mentioned, with the 14% into cash helped, but then we did buy other things. And I know you've got some questions for me on what stocks we like, which I can take later in the call.
Yeah, brilliant. Well, no, thank you, Ben. And I think what that really highlights as well is it's investing. It's logical. We're talking to our clients about their own personal economy and how they can manage any sort of liquidity crisis. And so people are earning less. They're running businesses. And so we know when we're planning for clients that these events happen. And not this particular sort, but things happen, and therefore it's important to have a balance sheet that's strong enough to get you through. Well, in the context of investing, it makes perfect sense that you would reflect first on companies that have got strong balance sheets that are in a position to basically ride this out. So thank you. Yeah, and I guess it leads in well to our next question, which is what are the opportunities that you're seeing in the market? And are there any areas in particular that you're avoiding? I know you've started to sort of talk about this a bit.
Yep, and there's others that I'll get to there. But I mean, I'll address your point around cash. You deal with small businesses every day. Cash is king. It is, and it's no different for a big business. And this is where we spend our time on balance sheets and cash flow statements. Is just what sort of custodians of cash are they? And you as an advisor are in that role for your clients. I'm your custodian of your cash flow through your lifetime. And we just think that is so important when you're investing, because then you don't get into irrational behaviour. You don't sell a stock because of its price fall, and you sell a stock because of the thesis that you built as to why to sell it. So we think cash is such an important thing to understand. You mentioned indexing before as well. We don't have any. We think indexes are great because they provide liquidity, and but we think now the thought of investing in everything isn't a great thing, because there's just too much irrationality there. That irrationality, I've talked a bit about what we wouldn't own. So what did we buy? What are we buying now? And there are companies. So at the time that we sold the likes of JB Hi-Fi, Wesfarmers, etc., that I spoke about, we like Telstra. I know some of us, I've been around long enough to remember when T2 came out and you could get it for $9. It's crazy to think it was that price once. We think Telstra is a stock that its dividend looks good, because if you go back 2 years ago, they cut its dividend dramatically. So that hurt had come out of it. And what are we all doing today? We're using bandwidth. And isn't it wonderful ringing Telstra to increase your bandwidth? It's one of the most, it's the call we never want to make, but they're going to do well. And we've been buying not just Telstra here, but telcos around the world. So Spark New Zealand has been one that we've owned, and Nippon in Japan is another one, and HKT in Hong Kong, because we just think bandwidth is how we are meeting today. We're going to be doing this. We're never going to stop doing this. The degrees at which we do it will change, but the amount of data we use will. So Telstra and telcos are definitely something we like. If one thing of the work that we've done over time, and we did some analysis sort of going back to 1940 of all the things that go wrong in stock markets, if you're worried about a bubble, and if we went into at the end of last year, when we looked around the world, looked at our own market, there were parts of it that were very expensive. We had some of our tech companies at 60 to 70 times their earnings. So you're paying a price today that you think is worth 60 times their earnings into the future, which for us is just ludicrous, because that's very hard to justify those sort of earnings. So given that, we sort of thought, okay, well, what do I want to own if there is a pullback? We didn't know COVID was going to come around the corner in January. But for the last 18 months, we've been very happy to buy gold stocks. We don't buy the physical metal, because the metal sits in a safe and does nothing. What we do own is we own the companies that can pay us a dividend. So Saracen Metals, Evolution, we've got a little bit of Newcrest, Regis Resources, and North Star. The reason we own 5 or 6, it's anywhere between 4 and 6 at any time, is each gold stock has got its own issues and opportunities. So we want to spread our risk there. Newcrest is an example. It's the most talked about gold stock. but its biggest mine is Arcadia around the Orange Bathurst region, and it's prone to earthquakes. So obviously when they happen, stock price will fall. So we want to spread our risk there. So gold is definitely something we like, we continue to like. And it's one of those things that when we have these fearful days or months or weeks, we see the gold price rally and those stocks rally as a result, we're able to take profits at those point in times because we can see people are on that thesis of, hey, I'm worried, I'll buy some gold stocks. We can trade out of those and reduce our positions. It's exactly the same on the other side. In April, when the world was thinking, I want to get into risk again, I want to buy banks, I want to buy resources, I want to buy expensive tech, they sell gold stocks. And we do the opposite, we buy them. And we've done a lot of that.
Ben, before you move on that point, there is a question from one of our attendees. It's just asked, can you explain why you wouldn't own the physical commodity?
Yep, we just, if I own an ETF or buy the commodity, it sits in a safe and I'm waiting for that price to move, and then I've got to sell at a profit. I don't get any income from that. It sits there, whereas I get the same impact on the gold price by owning a company that mines it, because it is hinged to the gold price to a degree, but we then get dividends and share buybacks and franking credits from those Australian companies as well. So we'd much prefer to own the company that mines it. And we've got world-class gold miners here in Australia. They've expanded from what they were years ago. Remember, it used to just be Lihir and Newcrest were the big two. Newcrest buys Lihir. We think Northern Star is a great operator. We think Regis is a good operator. Saracen Evolution. So we'd rather own the company that gets the benefit of the gold price going up, but we want to get the dividend and the franking credits as well.
Brilliant. I know I distracted you from your answer. There is another question that's come in, which might be timely to ask, just with relation to property. And I know, I guess, commercial property is something that's an investment option you've got available to you. Residential property you may or may not have a particular view on, but there's a pretty wide view on the potential falls they might suffer. Do you have any observations or comments regarding property?
Yep, we're certainly, and happy to, we do have views, and because there's companies like Stockland that we have owned, haven't owned for some time, that is both a retail mall and residential property play. REA Group, you would argue that's also hinged to residential property to a degree there as well. Again, we sold out of that. Let's break it into three areas. Let's look at retail, which we think is going to be bad for some time. And it's going to have to change. Our malls are going to have to move from just being about shopping to being a destination to go to do stuff, which clearly isn't going to happen for some time. How many people can you have in a mall? What's there? And we've seen some success of that in malls in Canada and the US. Those that have become places to go, particularly in towns where there's not much to do, helps as well. And it's why when we look at the likes of Camberwell and Bondi, we think they'll be fine because they're go-to places. There's so much there. You want to own those, but it's the malls that are only there for shopping that we think are going to be challenged for some time. There are a few where they've got a Coles, Woolies and Aldi as their anchor tenants. If those three are paying rent, which in a lot of cases they're not, and that's what I think a lot of people don't realise is quite often for a mall to get off the ground, they do a rent-free period for anchor tenants, like those three supermarkets. So the rentals aren't great. So we think retail is challenged. We thought it was anyway because we think the online habits of Australians will just increase. So retail is challenged, and it's going to take some time to work out what does a retail mall look like in the next 5 years. We own Dexus, so that's an office space. So we still have that, and we own Bunnings, and the property trust there. Bunnings we're very happy with. We'll continue to own that. Dexus we're doing a lot of work on because the office will change. The demand on office space is not going to be what it was. We don't agree with the thesis that everyone's going to work from home forever, though. Our own CEO, Seth Bernstein, was talking to him in the week, and he had been speaking to Larry Fink from BlackRock. He'd spoken to the head of Coca-Cola. He'd spoken to the head of Bank of America Merrill Lynch in that same week, and they were all of agreement that the office does so much for morale. And there's things that you can do in an office that you just can't do from working from home. It will put some pressure on rents, and we're seeing renegotiating rents. But for every office that's thinking we're going to do more from home, there's no doubt people will still want to buy office space. So we think it's where you own that office space is the key to that question. Residential property is interesting. Australians are fascinated with residential property more than any other country in the world. Going into this crisis, we were the most indebted household per capita nation in the world. That said, our assets are of strong quality, and we're well ahead of our debt to what other nations are. So if you look at the mortgage books of the two banks we do own, so Commonwealth Bank and Westpac, they're good mortgage books. Their borrowers are well ahead of their repayment. So even though we own a lot of property and we have a lot of debt, we're actually pretty good at repaying it. And we've gone into this crisis a lot better than what we did into the GFC. We were ahead of our mortgage repayments. I think the exuberance, though, for buying an asset around Australia that's going to yield less than 2 isn't that appealing. Certainly in Sydney, we've had too many apartments built, particularly in congregated areas like Zetland, around Homebush. And you've all seen on the news that these have been built with, you could say, questionable engineering standards, which has resulted in issues there. So I think residential property, there's not going to be a boom anytime soon. And our view has always been, if you buy a good asset in a place where people will want to live and rent, and you're prepared to hold on to that asset, then you wouldn't sell it. Melbourne and Sydney are not just Australian destinations, they are global destinations. There are people we talk to every day that live in Hong Kong, Shanghai, Beijing, New York, London, that look at Sydney and Melbourne as global cities. And that's how we think about those property markets. It's a bit different for Adelaide, Perth and Brisbane, although we think Perth will be a little better because there's going to be a lot of activity around mining and exploration. Same with Brisbane, because you'll see the fly in, fly out. However, the impact in Brisbane is there's a huge student population there, and they built way too many one-bedroom apartments in Brisbane given that no students have been able to come back, particularly those who weren't on Australian passports. So it's not the bleakest outlook, but we think you've just got to buy in suburbs where you know will be around that people want to live in. But poor rental yields won't be going up anytime soon.
Yeah, I think that's a good summary, and certainly from one of the concerns I have is around the immigration policy, that they're looking like they're going to really slow it down over the next couple of years. And if that happens, obviously Australia's economic growth is largely attributable in more recent times to immigration levels, and it's certainly been supportive of property prices. So with interest rates as low as they are, that's likely to act as a support, but losing any reduction in immigration is going to have an impact, certainly on price growth, I would have thought.
We are 100% aligned. It is particularly Sydney and Melbourne. We produce more jobs for the people that are prepared to take them, and as a result, we get highly skilled migrants come to our cities that spend money. They buy property, their kids go to schools, and they spend in our communities. And if we stop that, all those jobs, we're not producing the same amount of jobs. And healthcare is our biggest employer today. I know mining has been in the past, and building and construction, financial services is a big employer, but healthcare is huge. So there is still a demand there for, particularly around nursing and paramedics, etc., some specialty areas as well. But you're right, if we're not allowing immigrants into our country to bring their families here and to buy a house and spend in our communities, it's the reason we haven't had a recession since 1991. A lot of people look to the mining booms and those sort of things, but immigration is a big reason we've been able to keep economic growth positive.
Ben, how well do you actually see Australia faring in all of this compared to the rest of the world?
Look, we've done a remarkable job. You know, there's 100 people that passed away, and that's so sad. If you know those people, you know, it's a tragedy when people pass away as a result of a virus that was largely brought into the country. We haven't seen the transmissions that we have seen in other countries. Most of our cases have been brought in, so that's people that have flown back into Australia, We were super quick, or to be fair, in New South Wales, we didn't handle the Ruby Princess debacle well. The fact that we let them all off when they were unwell has clearly caused issues here, and we've got the new March House that has been a concern, or as a cluster as well. But by and large, when you look at how Australia has handled the isolation, so anyone coming back in, they're isolated. I know my wife works at ANZ. She goes to work 2 days a week. They have to take their temperature, and as they go into their headquarters, my son's gone back to school this week in Sydney. They have to have their temperature taken every day they go to school. So we've actually done it really well. In Queensland, they're bringing back elective surgery because they're through the worst of it. Tassie, South Australia, Western Australia are getting close to that as well because they've just had no new cases, which has certainly helped. So look, it's been pleasing to see how Australia has handled that. I'll caveat that with is we are a wealthy nation, and if anyone's travelled, if you think about the big cities around the world, they've all got slums. They've all got parts of their cities that people are living on top of each other in not great conditions. That's New York, London, Paris, Rome, Madrid. That is just the nature of those cities. We don't have that. We're not living on top of each other. So that certainly has helped. And we've listened. The isolation has worked. People have stayed at home, apart from the panic buying of toilet paper, which was just bizarre because it's one of the easiest things to produce and get on shelves. But for some reason, we were really worried about running out of loo roll and rice and pasta, all commodities that are readily available. So Australia has done well. We do think, though, it's going to be a slow grind out of this. It's not an immediate, everyone gets back to work. As I said, 6 million Australians have lost their jobs. We have a huge service economy, and by that I mean think of baristas. Think about our daily lives, what we used to do. We'd buy coffee in the morning. If you're me, you had another one at mid-morning just to keep going. We bought sandwiches at lunch. We sometimes bought breakfast. We went out 2 or 3 times a week. Australians, we love to travel, both within the country and overseas. So you think about companies like Samsonite as an example. Some of our global peers own that. They're not selling anything at the moment because no one's travelling. So it's going to be a grind at it. We've done well. It's about getting those 6 million Australians back into some sort of work. We're going to have a lot of debt to repay. How do we repay that back? A little bit of inflation, but we do see some upside around our mining and metals, particularly around iron ore, coking coal. Thermal coal has got some challenges around tariffs, but agriculture looks like it's going to have its best season in some time, particularly on the East Coast. So think dairy, think grain, think beef.
Excellent. Well, we have got quite a number of additional questions, some of which we're going to have to get back to after this directly. But one question, just given CSL's the biggest company on our stock market, it's also in that healthcare sector you mentioned. Do you have a view on it at the moment? You hold it, and I don't know if you, for example, know Avita, also out of the US. That might be a bit more obscure, but
yep, Avita, I know we don't own that at the moment. We tend to go a little bit larger on the global healthcare names. So things like Abbott Laboratories, Roche, those sort of companies is typically where we play in healthcare. CSL is an amazing Australian company. They're well run. We have owned a lot of CSL since we launched our fund in 2014. It's been a big part of our portfolio. As it became a bigger part of the index, though, what we call the beta of that stock got bigger to the point where on the days the market fell, it was falling more than the market. So over about 2.5 years ago, we started to reduce our position in CSL. Got over the 300 mark. As its position got bigger in the index, we reduced our position because it was just falling more than the market. It wasn't anything to do with the stock. It was just now moving with the market, and we didn't want to do that. So we own it. We've got it. It's in our portfolio. It's at about 60 basis points of our portfolio, but it's 10% of the index, so it's a big underweight. We have started to buy a little bit more of it, and the reason we had is we were worried about its ability to collect blood in the US because that's where they get most of their blood from, and because US is one of the few countries in the world you can pay for blood, and they do an amazing job at this because they they set up their centres in suburbs that aren't as well off, and they do them, and they've got them near bus stops. So on your way to work, you can go and give blood. And if you've never been into one of their centres in the US, they do an amazing job. They pay less than some of their competitors. But the way they make you feel as you leave, you know exactly what they're using your blood and the plasma for. And they let you know post that as well. So they get very good repeat donors come back to donate there. Clearly the big issue is places like New York, who can donate if they've been infected or been around an infection. We think they're on the other side of that now as to screening those who they can. The other thing we were worried about and had sold more stock in CSL at the beginning of this year was one of their biggest factories in terms of processing, in terms of blood into plasma, is in Switzerland. And Switzerland had initially the highest COVID outbreak rate per capita than any other country in Europe. But they've handled that exceptionally well. They've got a low death rate, and they've had more recoveries than any other country as well. So we're a little bit more bullish on the stock. We're going to remain underweight because, as I said, it's the biggest stock in Australia. It's one or two at any point in time, and so as a result, we just can't own it because it'll mean our portfolio will fall in line with what the market does.
Excellent, Ben. Well, last question from us today. If there's one word that you could share with investors right now to sum up your thinking, what would it be and why?
Defensive. We continue to be defensive. We think the reporting season that's about to hit us, there are going to be companies that come to market and say, I don't know what my cash flow is going to be. I mentioned Media and Cochlear. You can throw pretty much anyone around advertising. I think Southern Cross Media as well. Who is going to pay for advertising in this environment? So we think they're challenged. We think the banks they've been the stock market darlings for some time, and so we own two. We haven't owned NAB and ANZ for the best part of 8 weeks, and the main reason is they're more exposed to small business lending than the other two, and they do not have the quality mortgage books that Commonwealth Bank and Westpac do. But we own both at 3%, and if you think their index weights are close to 8, 9, 10, depending if it's the 300 or the 200. So we're defensive, but we are finding companies to invest in. I gave you some names earlier, but I should also mention companies like ResMed. We really like ResMed. We think they're an amazing company that produce, if you know anyone with sleep apnea, they're the ones that produce the masks and the machines that are behind that. And they sell an extraordinary amount of these in the US. And they're also a research firm as well, because they're able to use patient statistics and things that are now, they can connect the machines online. So we're very happy to own companies like that. And to be fair, I mentioned CSL before. Sonic we like, Ramsay we like here as well. We think Sonic's going to be the biggest player in pathology in Australia. So we're very keen to own those as well. So we'll always be defensive, James. We're your airbag. That's the role we want to play. And we look to people like yourself to sort of blend us with other managers that do other things in the portfolio.
Well, Ben, I'd like to thank you very much for your time today and wonderful insights. I certainly found it interesting, and I expect the audience did too. I also want to thank everyone for attending. We know your time is valuable, but before you go, may we just ask that you provide us some brief feedback